Good morning, everybody. It is Friday, February 19th, 2021, and we are going to talk about the dollar and oil and ETFs, some changes I'm making to the services, really just to allow a little bit more trend following for folks who are interested in doing it. And I think let's start with this chart. What did I tell you back in summer and early fall? I suggested that if Joe Biden wins the presidency, that would probably mark a bottom in the dollar. And so far, what we are finding out is that that is in case the fact. So if you go to my chart on TradingView, under this title, what you see is that the dollar was coming down, and now it has started to jitterbug right at that line that I said it would jitterbug at. So can it go down just a little bit? Yeah. This green zone here is where the massive dollar support is. If you've been following the news, you know that Janet Yellen has started the move towards firming up the dollar. So in last week's Tree Rings report, I covered one of these things already this week. They talked about the velocity of the federal debt, meaning for every dollar of debt we took, how much growth did we get? Well, now the debt that we're taking out is not providing much growth. In fact, what we are seeing is something that I showed you a while back. Remember this chart from about 3-4 months ago? I showed you that the debt that we've taken on since the financial crisis is much higher than the growth that we've seen since the financial crisis. And we had this one little period where we had the 1-to-1 during the Obama administration. $1 of debt gets us $1 of growth. And it's just gotten progressively worse under Trump. And then the coronavirus obviously spiked it. So $18 trillion of debt since the financial crisis, $7 trillion of growth. I talked about this months and months ago. This week, one of the most popular macro analysts out there starts to talk about it because somebody else brought it up. It goes towards the quality of production. Apparently, I just need to buy myself 1 million followers on Twitter and then put out a little bit better charts with big headlines. Well, I'm happy to be a little bit ahead in the game. This right here is a big problem. We need to get back to the point where we get over $1 of growth for every dollar of debt. That's a net win. We have not been net winning since about 2014, and it really got hammered during the coronavirus. So we need to pull this back up, not just to the 1-to-1 zone, but we need to get at least a 1.1, 1.2 number in here. And at that 1.5, I think we'd be fine. How do we do that with all the senior and retirement benefits that are coming due as the baby boomers retire? It's going to be difficult. The dollar is going to play a huge role. So when we talk about the dollar, we have to consider the treasury issuance. And what we know, and I showed this in a different chart a week ago, is that in the second half of this year, the United States is going to have to issue about $2 trillion of debt that the Fed doesn't have the capacity to buy. So we're going to have to find $2 trillion of U.S. debt buyers. That means that the interest rate probably has to tick up a little bit. We've already seen that in the long end of the curve, right? The 10-year Treasury is bumped up to about 1.3% from under 1% just several months ago. Who is going to buy all that debt? Well, interestingly, and this dovetails with oil, we've known that the petrodollar has been a very important thing for the United States since the early 1970s. So our partner, who we love very much because they're wonderful people in Saudi Arabia, are poised to buy a lot of U.S. debt this year. In return, they're going to pump more oil. They just announced it. I told you months and months ago that they would start pumping more oil in the spring, and that's what they're going to do. They've told us, starting in April, Saudi Arabia will pump more oil. That means that the price of oil is probably done going up. And it got to 60 faster than I thought it would. I thought it would take till next year to get to 60. But by controlling the market and with hot money in the hands of sweaty little know-nothing traders, they've been able to get the price of oil back up. So a combination of price manipulation in a relatively tightly controlled market and money chasers, people who are just chasing a trade. And these people who are chasing the trade are talking about how, oh, oil to the moon. Oh, oil's going to be around for 100 years. Oh, the secular decline in oil just magically disappeared in a few months. Don't fall for the bullshit narrative of traders who just want you to do something stupid. They want you to be the greater fool and buy their oil stocks now. And they want you to invest in oil now so they can escape their trade. And in a month or two, the traders who are chasing oil are going to flip the narrative. And it'll be something along the lines of, oh, demand isn't as robust as we thought it would be. Therefore, the price of oil needs to go back down to 45 or 50. So what is going to happen, and I say this with quite a bit of certainty, is you're going to see a couple million more barrels a day of oil coming out of OPEC starting by April. It'll be about 1 million barrels a day from Saudi Arabia and 1 million from everybody else, including Russia. You have to remember, they don't want the price of oil to go too high for two reasons. One, they need the economy to grow. And two, they don't want to make people even more excited about EVs than they already are. So last week, actually a few days ago, Ford announced that in Europe, they would be 100% EV and hybrid by 2026. How many times have I dropped the 2026 number to you in the last year? Over and over and over again, I told you, 2026 is the year that the ICE vehicle starts to die very quickly. It has to do with some legal things, has to do with the investment that corporations have made, auto companies have made into their facilities. They can't maintain two different types of production for a very long time. So this transition is going to happen very, very fast. So when GM made the announcement that they'd be hybrid and EV by 2030 and 2035 for EVs, what did I tell you that same week, a couple of weeks ago? I said Ford is going to beat that. Ford is going to come out and say EVs and hybrids by 2026 and all EV by 2030. You know, some small exceptions probably. Sports cars, heavy trucks. There'll be a couple small exceptions that remain hybrid. And exactly what I told you was going to happen has happened. And when I was telling everybody to buy Ford stock at $5, $6, $7 a share, I got skepticism. There comes a point when knowing what is happening makes a difference. And I get a little frustrated with some of the short-termism, and I haven't done the reading type of questions. What is going to happen in the next year or so is you're going to see the price of oil stabilize. It'll be in a range, 50s and 60s. Saudi Arabia is going to buy a lot of US debt, and the Middle East might end up becoming one of the better places to invest. Because during the next year or two, you're going to see half of the remaining US oil companies go bankrupt or merge themselves smaller, or two companies will merge and they'll end up being smaller. Think that through. $1 billion and a $2 billion company will merge, and it won't be a $3 billion company. It'll be a $2 billion company. That's how fast the shrinkage is going to happen. The U.S. oil sector is in big trouble. So this rally that you've seen is just that. It's a trader's rally driven by hot money, using margin, using calls, using the same sorts of things that drove GameStop up to $400 a share 3 weeks ago. And what did I say the day before GameStop peaked? I said within a couple of weeks, it'd be under $80 a share, maybe in the 40s. Where is it? How do I know the Saudis are going to buy treasuries? And in return, the Biden administration is going to keep being tough on the oil industry? Because you already started. Here's why. Saudi Arabia is already a big buyer of U.S. debt, and it's going to tick up significantly. And the United States is going to start telling countries around the world, Bitcoin isn't where you want to be. I've also told you a digital dollar is coming. I told you that had to do with preserving the dollar as the reserve currency. So the dollar is bottoming right now. There needs to be $2 trillion of U.S. treasuries issued later this year that we have to find buyers for. Where has money been going that has kind of diluted not only the dollar, but gold? It's been Bitcoin. So here's a conversation that Groman over at Tree Rings, Forest for the Trees, had. If you're not subscribing to FFTT, you really should. I mean, this $200 subscription along with Bloomberg, and then whatever Value Walk is for 100, for $500 a year, you wouldn't have to read anything else, I don't think. I go to the sources that they have in here, but between Tree Rings and Value Walk, talk about macro and then top investment ideas from hedge funds and value investors. I'll be published on Value Walk starting next week, by the way. And then Bloomberg for all your data and global coverage. I mean, there you go. And then me, of course, helping you pick out the right stocks and ETFs. But in any case, here they talk about how China wants to help or spur along the devaluation of the dollar and for it to not be so much of a reserve currency. Here's the problem. Nobody trusts China. Nobody trusts Russia. China's growth is almost over. Next 10 or 20 years, China's in big trouble because of their demographic. Who's going to move to China if they open up the borders? What can they do demographically? There's nothing they can do. I mean, I guess they could start forcibly making women have more babies. I guess that's not beyond the commies. But the reality is that China has a major, major demographic problem, and they still don't have most of their population out of poverty. China's not the place to be invested. I mean, there's a handful of things you want to be invested in there. But the time to invest in China was 20, 30 years ago. They're running into major, major demographic problems. And by the way, everybody hates the commies. So what can the dollar do to preserve itself as the reserve currency? And why is it so important? It has to do with trade. A lot of our standard of living in America is the free ride we get by being the big, trustworthy nation that everybody wants to use their currency. It's actually going to be easier to deal with China, theoretically, presuming they don't resort to war, than it is going to be to shut down Bitcoin a bit. The government, the Treasury Department, does not want to see corporations start putting their money into Bitcoin. Why? Because it ends up giving the corporations more power than the government. That's already a struggle in America. It also dilutes the value of the dollar, and that's bad for most Americans. So while the Fed has been a trickle-down patsy for 40 years, and really bad since Greenspan, Janet Yellen isn't in that camp. Janet Yellen wants to see the middle class do well. That's why we had that sideways market for a couple of years, because she was doing everything she could to normalize after what was an epic financial collapse globally. And then we get a bunch of good times deficit spending from Donnie that still left us vulnerable to an event. And now we have to spend our way out of it. But then at the end of the day, we have to say, well, at what point do we start getting more out of the economy than what we're putting in? Those hard discussions are coming. So as I said, you can expect tighter regulation on Bitcoin. It's coming. You can also expect some changes. There was an announcement today, actually, changes to the way that small investors are given margin and option trading capabilities. I can tell you as an advisor, I've seen it 1,000 times, literally 1,000 times. Brokers that I've known, advisors that I've known, those forms that give people option trading capability and margin rights, people lie on that stuff left and right to get the rubber stamp approval from the brokerages so they can trade over their head. Why do the brokerages allow that? Because they make more money. So you're going to see soon some screws from a regulatory side being put towards brokerages that haven't been diligent in monitoring how people trade. And that's going to partially impact Bitcoin. And there's a number of other things that can be done to thwart the rise of Bitcoin, regulate it like a commodity, prevent it from having direct transactions into the financial system. I mean, that's the biggest one. And then create a digital dollar that is controlled by the Treasury rather than the Fed, but that requires Federal Reserve dollars to buy. So while the Federal Reserve on the domestic side can engage in counter-cyclical policy, if that devalues, that means that your digital dollar won't cost $1, it will cost $1.02 or $1.05 or $1.10, because that's going to be pegged to something like inflation. It's going to be a shadow currency, essentially an international currency versus the Fed's dollar, which is going to become a domestic currency. Then everybody runs to put their money into the digital dollar, which has a fixed supply, plus a point or two or three every year of increased supply for inflation. According to the CIA, and most of the numbers I read, if the Treasury created 80 trillion digital dollars and then priced them in dollars and said you can only buy this with a US dollar, what do you think that would do for the ability to issue US debt? Prop it up pretty good, right? Expect these things to happen. Expect them to happen faster than you think, because the technology isn't a problem, right? If Bitcoin can exist, they can create a digital dollar. They just have to figure out what is best for the dollar as a reserve currency for that to work. And they'll come up with their formula and they'll tweak it probably a few times to get it right. But Bitcoin's got a problem coming because they don't make the rules of the financial system. And that a bunch of crypto anarchists and half right, half wrong Austrian economists can apply things to a US economic model without any sense of the fact that the United States is in fact special is silly. Immanuel Kant, Theory and Practice. The United States is a special economy. We check all the boxes. And yeah, we steal from each other. We shit on each other. We argue about things that we don't understand. But the reality is, when you check the boxes for strength of a currency, only Europe comes close to the United States, and they don't seem to want to work together for any long period of time. They seem to be doing a little better lately. But even now, you hear Russia talking about pulling out of, deals with Europe and just working with some of the Eastern European countries that are, friendly to Russia, i.e. oligarchs who have been given control of foreign countries, right? You've got Russians in Eastern Europe or people who've been bought by the Russians get power. You've seen that in Ukraine, that when the Ukraine stepped away from Russia, Russia took a third of the country. There's still probably a comeuppance from that. So while Joe Biden may not remember everything anymore, he remembers a lot of stuff. So expect the dollar to firm up here, could go a little lower, but it's going to firm up here a year or two out. Why? Because the long-term treasury rate has to stay about where it is. It can't really go back to a half point or 60 basis points or whatever it got down to. You need to compensate the people who are going to buy all these treasuries in the next couple of years. And part of that compensation will be the oil equation with the Middle East, Saudi Arabia in particular. And if you don't think that this is already happening, oh, by the way, Janet Baby already had the call. I'm not telling you something that I'm postulating is possible. The call was just made. It's happening. So as the dollar firms, the stock market's going to have to adjust. And all these moving pieces are going to play into each other. You're going to see margin debt start to decline. You're going to see call option buying start to decline among retail investors. The short sellers are going to come back as small traders have some clamps put on them, some limitations. And those limitations might only be that you have to agree a little bit more fervently that you're speculating and know that you can lose all your money. That if you lose margin, if you use margin, you can lose more than what you put in. You can get a bill. So expect there to be heavy discouragement through the regulatory system on people from speculating in calls, but in particular using margin. And it might just come in the form of changing margin requirement. That'd be the easiest way to do it. Because you can tell people this is dangerous all you want, but if they think they can get rich quick, they'll do it anyway. So you have to raise margin requirement, unless you can show the ability to finance a potential debt. ETFs. That's really where we end this program with every week. So one thing that I have been asked for, and I have shied away from, is a little bit more ETF trading. So again, if you have TradingView, you have a very flexible screener. You can screen based on a daily chart, or you can screen based on a weekly, and then a bunch of other time frames. Well, the weekly is where you get your best signals if you're an investor. If you're a trader, it's a little bit different. And if you're a hybrid that, hey, I want to invest with most of my portfolio, but I want to trade part of it, then that daily chart comes in handy. So what we can see is of all the stocks, all the ETFs on the ETF favorite list, very few are oversold on the daily chart. GDXs, a bunch of these bonds are too. I'll probably remove some of those from the list because honestly, there's not a lot of reason to be in bonds. We've talked about that before. Gold is oversold. So we pull up this chart. What you can see is that gold is almost to the buy zone that we set up 5, 6, 7 months ago when I did something unique with the Fibonacci's and I measured it in reverse. And I skipped certain time frames because of the pandemic. So here you take a look at this, you say, look, Kirk said if it gets down to about 162, probably start taking a look at buying it. It's down to 167. It was at 190-ish, over 190. You can almost start selling puts on this, but I would wait. Let's get that one more tick down with a stronger dollar. Try to get a net cost in here, 150-ish, when you set up your put sales. So what you might do is you might sell a $160 put, but not sell it until you can get $10 a premium. The same thing with GDX, except that it's much closer. 32.88 today. Told you 33. You could probably start selling cash secured puts at the $33 level or even 35, but just make sure that your net price is 30-ish, right about here. And it could fall down to 28-ish. So you're in this range. So just make sure that your strike minus the premium that you receive gives you a net price in here somewhere. Going back to the screener, you see there's not much to buy. Now, if we switch back to the weekly chart, right, GDX and gold are still basically at the edge of oversold. And the daily chart is telling you that they're close to reversing. If you flip this around here, you go, look at all the overbought. Everybody got a little breathy the last couple of days because the market went down. Started up today. I don't know if it's down yet. I wouldn't be surprised to see it close down, even though it opened the day up. And in particular, you should expect energy ETFs to start getting beat up pretty heavily sometime in the next month or two. So in our Swinging for the Fences articles, which will become a lot more regular, there's probably going to be some opportunities to bet against oil and oil stocks in particular. But you're going to have to figure out how to manage those positions because remember, when you buy a put, you're on the clock. You have to be very, very accurate, precise for those trades to work out. So what you're usually better off doing is just selling all your oil stocks at this point, while there's still greater fools out there, because the stampede out is going to happen eventually. Once the traders can't talk this stuff up anymore, and the Saudis come in and confirm again that they're going to pump more oil, and the dollar starts to firm up in the face of all these people calling for a dollar collapse, I'm telling you, what I'm seeing today is the same thing that I saw in 2012. The dollar's already down. I told you when it was way up where it was, it would come down, but that it'd be range bound. It had very firm support at a certain level. I want you to put this into your head and leave it there and come back to it over and over and over again. The US dollar is the reserve currency, not because of some weird deal, not because of petrodollar, not because of whatever you think makes it the reserve currency. And it doesn't get weak because we run a deficit or we have debt. Everything with the dollar is relative. All currencies are relative. And when compared to the other major currencies, there is no alternative to the dollar. It will never be a Chinese currency while they're communists. It'll never be a Russian currency while people like Putin run that country. Currency comes down to trust. Bitcoin has shown the United States what it needs to do to create a currency that everybody wants. You take most of the good things from Bitcoin, you incorporate it into the dollar. You create 2 US dollars, one that's primary international and for trade, and one that's a domestic currency. Europe and Japan and others are going to do the same thing. So when everybody's using the same technology, when everybody has blockchain or whatever's next, and in a world where supply chains are moving close to where the consumers and the resources are, we have both. Where it's safe, except that we kill each other, we're pretty safe. Where you have a semblance of legal structure and a political system that doesn't break. I mean, let's face it, folks. If Donald Trump couldn't destroy the republic and the legal system, it's pretty freaking strong if he tried. So consider this. The dollar is going to stop getting weaker very soon, probably get a little stronger as the United States comes out of this downturn pretty good. You're going to see a 1.9 trillion, maybe even $2 or $3 trillion worth of stimulus between now and summer. Why? Because you're probably going to get $1 trillion infrastructure package. I frankly think they should just add it to reconciliation because I don't think they'll get 10 Republican votes. If they can't get 10 Republican votes, then they can do reconciliation again later in the year. They can only do it, I believe, 5 times in the next 2 years. I think that's what it works out to be. Might be next 3 years. And we're going to do what? What have I said that we have to do to fix everything? Rebuild the world. Well, we're going to start by rebuilding America. And we're going to rebuild the dollar. And in the short term, that's going to cause some shaking out in the stock market. Will we get that 30 or 40% correction that would make buying easy? Probably not. I think we get a 2015-16 period where you get rotating corrections. And that's where having the new weekly updates on the ETFs is going to matter. So each week, I'm going to have a template that comes out on Monday. I'm going to have a lot more coming out on Mondays. Just going to make Thursday and Friday more like my weekend, and Saturday and Sunday do some work because I want to use the end of the week chart. And we'll drop in the 15 to 20 ETFs that we're using regularly, and it'll show you where you can buy it to ride a trend and how tight you should set your trailing stop. So if you want to ride some of these trends for the several weeks to a few months that some of these trends run, you can do that. And it would have obviously been better over the last rebound period. I focus on 6 months to a few years for my trades. And I know that some of you want something that's a little bit shorter term in duration. So we'll do that with the ETFs. And then swinging for the fences, we'll focus on the stocks. And that'll give you the ability to play those 1 to 5 months trades. I don't think it should be a big part of your portfolio, maybe a quarter on the high side. I will tell you, when you're not in a raging speculative bull market, you quickly become aware that you're not quite as good of a trader as you thought you were. So all these people who think they're data driven, really they're just riding the hype. What did we learn 30 years ago? Don't believe the hype. All right. I had a question about Palantir that I wasn't going to answer, but I thought I would because I think it's instructive to some of the other stocks that we're in. So with Palantir, they're in a period now where the locked down shares, people can sell their shares. And that quickly drove the stock price from upper 30s to 30-ish. A number of investors, including Kathy Wood, are using this as an opportunity to accumulate some shares. About 25-ish. It's probably a pretty good spot to buy some Palantir shares if you want to speculate that they're going to grow the way that I said they might grow. Now, it would be better if we could find a lower price. So the question we have to ask is, will there be one? I don't think so. Low 20s maybe. So you have some pretty big buyers in here. I think the 25 is probably where you want to set your limit orders. Or you could maybe, I haven't checked the premiums. We'll talk about it on Tuesday. But you might be able to sell some cash secured puts. Sell some cash secured puts at a 30 maybe, if you can get over $5 in premium. So we'll go to the handy dandy Yahoo because apparently the investment firms can't make anything this easy. Say March. Yeah, maybe. I'd wait for a down day. This $3 that is up today will come off. But if you just really are in love with the stock, I'm not. I like it, but I don't know if it's a top 30 idea for me. And I think maybe yesterday would have been the day. But you're going to have to wait for this kind of hype to come off. Right? This is all headline driven. Kathy Wood bought some. I got to buy it. I've told you the problem with ARK Investments now. ARK, you see how often I check my Yahoo email. The problem with ARK Investments is that they're up over $60 billion now. And the funds that did great when they had 20 to 30 stocks now have 50 to 60 stocks. When the market tightens up, when people start to sell, that will be amplified at ARK, but then also the underlying stock. So you have to be very careful with these hot stocks because just as fast as the money floods in, it pushes you up the stairwell, push you right down the elevator chute later on. So stick with your charting, stick with an understanding that the dollar is probably firming up now. Interest rates are going to probably stay just a little bit higher than they were before. And if they have to bail out the repo market again because it looks shaky, they're going to have limited resources. That is something to keep in mind. So remember back in 2019, they had to bail out the repo market for $1 trillion. What are they going to do to bail out the repo market next time? You can see the writing on the wall with this administration versus the Trump administration that the socialism for corporations and financial institutions will not be so strong. Because that's really what some of those bailouts have been. It's been socialism for the corporations, right? Privatized profits and socialized losses. If they allow a big hedge fund to go under, it'll be up to the Citadels and the 0.72s of the world to bail out the institutions as an investor versus using government money. And given that the government's put so much money into the system and the billionaires have done so well during this pandemic, obscenely well, you don't want to get in the way of that tidal wave. This administration is not going to bail out rich people unless it becomes a systematic problem to the system, something that could structurally hurt the banking system. But the Treasury Department has already started to preemptively fortify the banks. The Treasury is taking money out of its Federal Reserve account and just sending it to the banks. It's a big pile of money too. It's way into the hundreds of billions. So the Treasury is helping the banks fortify their balance sheets right now with the idea that if there's a shake in the market, we already gave you the money, use it the right way. So expect all these changes to the system to happen soon. Expect fewer bailouts for the wealthy and understand that stock prices will get shook by that. And those will be your opportunities to buy. Any questions? Somebody mentions that at 1.3%, a 10-year Treasury is a negative real interest rate. Yeah. And that's why Jamie Dimon said he went to touch 10-year treasuries with a 10-foot pole. And that's probably why the Treasury is just sending their Federal Reserve reserves to the banks right now. They're just mailing them checks. And the banks probably deposit that money at the Federal Reserve themselves. And it's probably all digital. It's probably a couple clicks. But it's basically the Treasury telling the banks, hey, we're going to help you fortify your balance sheet because things might get a little choppy. And we're not going to bail out the hedge fund that goes under. And it'll be a big one. Might be one of the same ones that was going under in late 2019 when I told you that there was a self-bailout going on. So somebody says if the dollar goes up, that means gold goes down. That's not true. They move in the same direction all the time. Look at the underlying factors. Gold is only down because Bitcoin has a rally. And once there's a little bit of constriction put on Bitcoin, more money will float into gold. And by the way, if you don't understand that the millennials are predatory traders, that they're just going to go where they think they can make money, that's a little less ideological than you think it might be, then you start to understand this a little bit better. And here's something else you should think about the millennials. They do think that the boomers screwed up the system for them, and they do think they're here to save it. Go and read Reddit. They talk about it all the time. The boomers screwed things up. Let's take their money. Let's ask for higher wages, and let's take their money in the stock market. Somebody mentioned Churchill, CCIV. Yeah, I did. I mentioned it around 20. It's at 60 now on that Lucid rumor. Not a chance in the world I would touch that right now. If I thought it was safe to short things, I'd probably short it. I don't think it's safe to short things, so I don't. It won't be safe to short things till the dollar starts to move up, till liquidity gets a little tighter. I think that's later this year, but I'm not positive. And for most people, you can have a long investment where the calendar is on your side and have infinite upside over time versus trying to catch a short where you have to be extremely precise and you might get the Reddit army to hate you. You know, right? I'm not a cat. Yeah, if anybody saw the interview with the guy from Robinhood, it was funny. It was funny. He just made fun of everybody. He called them stupid without calling them stupid, which was just beautiful. Oh, the Reddit guy. Yeah, whatever. I think that one of those SPACs that we got into, right, the one that's moving pretty fast, is going to do really well because I think that, unfortunately, big money is going to fill a lot of the holes of small business. So while small cap stocks will do well, you have to be selective. I think it's more likely that the rich get richer because these SPACs are going to replace a lot of the zombie companies. It's actually something that I'm going to write. A lot of these SPACs, dozens of them, are going to grow to be over $10 billion companies. And as the zombies start to shrink, they'll kill those zombies. And those zombies will end up going into small cap indexes away from the S&P 500. So if you can flip it, right? these SPACs that we bought, these 8 SPACs that we bought, you ought to buy all 8 of them. You really should. You really, really should, because 2 or 3 of them are going to hit home runs, maybe more. We got them with low risk, and we just have to see what the deal is. We're speculating the correct way on these SPACs. Back when I told you to buy the SPAC that ended up buying Nikola, and when I talked about the SPAC that became MP, it's the same thing. You buy these SPACs at $10, $11, $12 a share, and then you wait to see what the deal is. And if it's a great deal, the stock's going to go straight up. And if it's not a great deal, the stock chops along, and you can ask for your money back. Very low risk, right? Because they have a lot of money in trust. You can cash out if you need to for most of what you put in. I mean, it's a really good way to have downside of 10 or 20 or 30%, but upside of hundreds and hundreds of percent. That's the type of asymmetric equation that you want as an investor. I want a ton of upside with only a little bit of downside. That's why that SPAC basket is the way to do it. Yeah, and that is like CCIV. I identified that one based on the way it was set up, the people it was set up with, and the money that they had. Right? There is a very short checklist of what you're looking for with a SPAC. Good people, a big enough pile of money to not have to buy something speculative, and cheap after the IPO, so that you still have the trust money there as the backstop against them either A, not doing a deal, or doing a deal you don't like that you want to escape. I mean, you really only have downside to like $9 or so in most of these SPACs. So if you buy them at 10, 11, 12, 13, you don't have an infinite downside. You don't have going to zero risk. But if they make a good deal, you could really buy yourself some liberty. All right, let's call it a day. I'm going to go babysit the Hulk this afternoon, and between now and then, I'm going to get some work done for you. Have a fantastic weekend.